Most people lose money in the stock market not because they're stupid, but because they don't understand the language.
If you've ever opened CNBC, Yahoo Finance, or a trading app like Robinhood or Fidelity and thought, everyone else seems to get this, but I don't, you're not alone.
Words like market cap, ETFs, volatility, dividends, bull market get thrown around constantly, but most beginners never get a clear, simple explanation.
So in today's video, I'm going to break down over 100 essential stock market terms that every beginner investing in the U.S. stock market should understand.
To keep this simple, I've broken everything into clear sections, starting with the basics and gradually moving toward more advanced concepts. No jargon overload, no hype, no confusing Wall Street language.
If you watch this entire video, you'll understand how the U.S. stock market works at a level that already puts you ahead of most beginners.
Welcome to the channel, where we explain investing clearly, practically, and honestly.
Quick disclaimer before we start. This video is for educational purposes only. This is not financial advice.
What stocks really are? Let's start with the foundation. What is a stock? A stock represents ownership in a company. When you buy one share of stock, you're buying a small ownership stake in that business. For example, if you own Apple stock, you own a tiny piece of Apple. Types of stock. Common stock. This is what most investors own. You may receive dividends, and you usually get voting rights. Preferred stock. Preferred shareholders usually receive fixed dividends, but typically don't get voting rights. If a company runs into trouble, preferred shareholders get paid before common shareholders.
Public versus private companies. A public company is listed on a stock exchange and can be bought by anyone. Examples include Apple, Microsoft, Amazon, and Google. A private company is not publicly listed and is owned by founders, employees, or private investors.
Portfolio and dividends. A portfolio is simply the collection of all your investments. Some companies pay dividends, which are cash payments made to shareholders from company profits, usually quarterly.
Indexes and the market. When people say the market, they're usually talking about indexes. An index tracks the performance of a group of stocks and acts as a benchmark.
Major U.S. indexes. S&P 500, 500 large U.S. companies. NASDAQ Composite, heavily weighted toward technology stocks. Dow Jones Industrial Average, 30 major U.S. corporations. Russell 2000, small-cap U.S. companies. When investors say they want to beat the market, they usually mean outperforming the S&P 500. And here's something beginners should know early. Beating the market consistently is extremely difficult, even for professionals.
How trading works. Stocks trade on stock exchanges, which are marketplaces for buying and selling shares.
Major U.S. exchanges. New York Stock Exchange, NYSE. NASDAQ. To trade stocks, you need a brokerage account. Examples include Fidelity, Charles Schwab, and Robinhood. Each stock has a ticker symbol, like AAPL for Apple, MSFT for Microsoft, TSLA for Tesla. Market hours. Normal U.S. market hours are 9:30 a.m. to 4 p.m. Eastern Time. There's also pre-market trading, after-hours trading. These sessions usually have lower volume and liquidity, meaning prices can move faster and more unpredictably. Company valuation terms. This is where many beginners get confused, so pay close attention. Market capitalization. Market cap is the total value of a company's shares. It's calculated by stock price multiplied by shares outstanding. Enterprise value. Enterprise value includes market cap plus debt minus cash. It gives a more complete picture of what a company is truly worth. Revenue and profit. Revenue is total sales. Net income is profit after all expenses. On financial statements, you'll also see assets, what the company owns, and liabilities, what it owes. Key ratios: EPS, earnings per share; PE ratio, price compared to earnings; PEG ratio, PE adjusted for growth; dividend yield, income relative to price; free cash flow, cash left after expenses. Margins: gross margin, operating margin, net profit margin. Margins show how efficiently a company operates. Types of stocks: growth stocks, focused on expansion and reinvesting profits. Value stocks appear undervalued compared to fundamentals. Blue chip stocks, large, stable leaders like Coca-Cola or Johnson & Johnson. Cyclical versus defensive. Cyclical stocks rise and fall with the economy. Defensive stocks remain more stable during downturns. Company size: large cap, $10 billion plus. Mid cap, $2 billion to $10 billion. Small cap, under $2 billion. Penny stocks trade under $5 and are highly speculative. Funds and investment vehicles. Mutual funds, professionally managed portfolios that trade once per day. ETFs, trade like stocks and often track indexes. Index funds, passive funds designed to match market performance. Hedge funds, private, high-risk funds for wealthy investors. Retirement accounts, Roth IRA, tax-free growth. Traditional IRA, tax-deferred growth. Other assets, bonds, commodities, currencies, cryptocurrencies. Market behavior and risk. Volatility, measures how much prices move. VIX, often called the market's fear gauge. Market cycles: bull market, bear market, correction, crash. Sentiment and bubbles. Market sentiment reflects investor emotions. Bubbles form when hype replaces fundamentals. Investing strategies: passive investing, buy broad funds, hold long term, use dollar cost averaging. Active investing, stock picking, market timing, higher risk. Analysis types: fundamental analysis, technical analysis, macro analysis. Corporate actions and portfolios. Corporate actions: IPOs, buybacks, stock splits, acquisitions. Portfolio management: diversification, asset allocation, rebalancing, performance metrics, alpha, beta, Sharpe ratio, correlation. Economy and policy. Economic terms: inflation, deflation, recession, stagflation. Government role: monetary policy, Federal Reserve. Fiscal policy, government spending and taxes. That was a clear, beginner-friendly breakdown of over 100 essential U.S. stock market terms. You don't need to memorize everything. Understanding builds over time and repetition. This single video can save you years of confusion and costly mistakes. If this video helped you, like the video. Subscribe for more clear U.S. investing education. Thanks for watching, and I'll see you in the next one.